Good morning, everybody. Welcome to Tuesday weekly webinar. Good to see you. It's been, I guess, a week. Yeah, it's been 2 weeks. So we had a market holiday last week, so we don't have webinars that follow market holidays. But here we are. It's January 23rd. I'm going to talk about this a little bit, but I just came back from a nice visit with David McKnight and a group of the Power Zero advisors. There were a couple hundred of us that got together in Scottsdale, Arizona last week. And it was a really nice event. And I got to see my friend Dave and many others within Dave's team and some of the best financial advisors around the country, in my opinion. So I'll talk a little bit more about that. But if you're just joining us for the first time today, please hit the like, subscribe, and notification button. I'll tell you that you get notified of videos faster if you have notifications set and if you're a subscriber. So we're going to follow the same format. Today we're going to go over some updates from the Slott group, and then we're going to talk about the markets a little bit. And then we've got our Financial 15 today, which is tax bracket updates for 2024. And the updated charts should be on our website, I would say probably by the end of the week. And if you haven't done it already, you can go onto our website at attleboroughwealth.com. That's right up here, attleboroughwealth.com. And you can download those. Now, the ones on the website today are still 2023. Historically, I like to keep those 2023 charts up until about April, but we're gonna shift them a little earlier this year because we have a class coming up, and we do in fact have a class starting on January 30th. So 2 Tuesdays and 2 Thursdays, and if you're on my email distribution list, you've already been invited to these classes, and feel free to sign up. This is a webinar style class, so there really is an unlimited number of attendees, which is really nice. We had a lot of discussions when I was in Scottsdale. You know, I was honored to be asked to speak at this conference. And a lot of people come up to you and ask you about things after you present to an audience like that. And people were asking me about the university workshops that I do with Dave or with Dave's material. And maybe we'll do another live one this year, but I like the webinar format, and I think you folks seem to also. We have over 70 or more registrants already for the upcoming class. And a normal live class would be 40, 50. So the registration levels are higher with web classes. It's a little more comfortable, a little easier, but the information comes across just as well, I'm told, from you folks. But we might do a live class locally here. I'm not sure. Maybe towards the end of the year. But anyway, so we've got the webinar starting on January 30th. So 2 Tuesdays, January 30th and February 6th, and 2 Thursdays, February 1st and February 8th. Now, the last class that we did at the end of the year, we had a recording available, and I had sent that out to all of you folks who are on our email distribution list. And I kept it open for some time, but I did close that down at the end of December. Or excuse me, I guess that was the end of December. I made that private, so you can no longer access that recording. I can't be as free with those recordings because it's not my material. As I said, it's David McKnight's material. I talked a little bit about the Power Zero event in Scottsdale, Arizona. Again, really fantastic event. Some of the best thought leaders in the industry. You know, I spent a good amount of time talking to Dave McKnight, but you know, again, just some of the folks that were present and the conversations that we're having about tax efficient planning and working directly with clients in their specific situations. You know, it's just always inspiring to me to hear what people are working on and doing. And Dave has this goal of you know, bringing $100,000 people. You see how I think, right? I'm always thinking in the finance, but the 100,000 people to tax efficiency or zero tax, if possible, in retirement. So his goal is 100,000 families within 10 years. And I think that's a really wonderful goal, because one of the things that I was talking to a person about and a group of people about was, you know, that the life-changing difference that having an additional $1 million or $500,000, or for some people $100,000, and for some people millions of dollars, different. The amount that's available to you, those dollar amounts I was talking about, the 100, 500 million, 2 million, sometimes more dollars that's available to you during your lifetime that you're keeping instead of paying to tax is significant, right? And that is certainly life-changing. So it's these small changes that we're able to make, these critical items you always hear me talk about, that can have dramatic impact in your retirement and your entire life. And, I was just thinking of someone I was talking to a couple weeks ago, and we were doing that comparison, that side-by-side comparison. By the way, if I haven't done that for you yet and you want to reach out to us and schedule a time for us to do a side-by-side before and after comparison of what your current strategy is compared to your tax-efficient strategy, I'm happy to do that. And you can reach us at questions@attleborowealth.com. I just changed it. That's over here, the top of this screen. That's questions@attleborowealth.com. And we'll schedule a time for you to do that. Whether it's that additional funds, $1 million more that you can pass to your heirs, $1 million more that you can spend for fun, $1 million more that you have to take care of yourself if you need long-term care for you and or your spouse. It's obviously life-changing, and these are these critical items that maybe if you knew things differently before, you would have done things differently, but you learn them now through this class, through these webinars, and you can make changes as you move forward, and they can have dramatic impact, and I would say life-changing impact. So it's all very exciting. So it's exciting to be with a group of individuals like that, whether it's the Power Zero event, whether it's the Slott training events that we have, and it always inspires me, it always excites me, and I'm always happy to bring those things back to you folks. So again, we're going to talk about also in the same context as Power Zero. So right before, I guess it was a couple weeks ago, Dave called me, Dave McKnight, and he said, "Hey, are you available tomorrow to do a podcast?" And he said, the podcast that I did with you has the largest number of streams on my YouTube channel. And he said, so I'd like to do another one. So I agreed to do that. So a couple Fridays ago, I set up here in the studio and I did a recording with Dave. And he usually breaks it down to about 3 or 4 because we talked for about an hour or so and about different topics. And so if you don't subscribe yet to David McKnight's podcast, you should. It's the Power Zero podcast. And you can find it wherever you find your podcasts. But even if you're not a subscriber, listen to the upcoming podcast. There'll be 3 or 4 of them that will include me, and we'll talk about a lot of different topics. One of them is this Penn Wharton study that came out, and I have to actually dedicate a webinar to that. That not unlike the Treasury report that we've received from our federal government, and not unlike so many other telling signs and basically academic reports that have come out, whether they're from government or other institutions, saying that the path that we're on is unsustainable as a nation financially. This report supported that approach, that this path is unsustainable that we're on. It gave it a little bit of a longer timeline than I would have liked. It talks about a 20-year period of time. We firmly believe that by 2030, something has to be done, and that something typically is and has to be increasing taxes. But this Penn Wharton study talks about a 20-year period of time, which concerns me because politicians read these things, and that's really who this study is directed to. It's information for the public, but it's, hey, Congress, get your stuff together so that we can avoid this issue. I'm just taking a note here. But one of the things Dave asked me during the webinar, and that's why I'm bringing it up, is, hey, Mark, what do you think of this Penn Wharton study? And I said, I don't like that they gave him this 20-year window, because suddenly Congress sits back and says, well, heck, I'm going to be retired. Well, maybe they stay until they're 85, 90 years old. But, hey, I'm going to be retired by the time this happens, so I don't have to worry about it. And I'd like to see some urgency from our government to correct these financial issues. and I'm conflicted. I've shared with you as a planner, I enjoy it when we have some when they continue to kick the can, which I think they're going to do, even with these Tax Cuts and Jobs Act issues. But as a planner, I enjoy that because it gives them more time to set people up, right? To take advantage of the lower tax rates and be able to do these Roth conversions and tax efficient planning and give families these extra funds to work with. But as a father, I certainly don't like to see this happen because we're really handing our children a mess, just a mess. I don't know how else to say it. All right, so moving on. Let's talk about the slot report for this week, and I'm going to share my screen here with you. And we're going to talk about, this is a little report from Sarah Brenner. We've talked about Sarah a lot, but this is outstanding rollovers, what you need to know. So read along with me here. So this just came out yesterday. The rules for rolling over IRA distributions can be complicated. These rules can become especially challenging at the end of the calendar year. If you're taking a distribution from your IRA at the end of 2023 and considering a rollover that may not be completed until 2024, here are 4 facts you will want to know. So it really does get confusing at the end of the year because we have in our mind this gate that, and I talk about it, things that have to be done at the end of the year. Well, certain distributions have to be done at the end of the year, so whether it's RMDs, required minimum distributions, beyond that first year, you've got to get those IRA funds distributed by 12/31 of that year. Roth conversions have to be done, of course, by 12/31 of the year that you're doing that conversion. Let's see, what else is there? Well, certainly RMD, QCDs, qualified charitable distributions, have to be done by 12/31. But then what happens after that? We had a conversation with somebody about, well, hey, we've got a QCD that's going out to a charity. What if that charity doesn't cash the check? Well, what happens kind of in that gray zone? What happens after we've crossed that 12/31? We've done our part, distributed those funds, and does it have to, checks have to be deposited, things like that? Well, this has to do with rollovers, because rollovers are your responsibility, nobody else's responsibility. We do a lot for our clients. We make sure things are done appropriately. We make sure that things are done timely. We make sure that you don't get caught in these traps to the best of our ability, but it really is your responsibility to get these things done. So let's talk. Sarah did this good piece, I thought, about rollovers. So let's talk about this. So, all right, surprisingly, sometimes IRA owners have doubts as to whether a distribution taken in one calendar year can even be rolled over in the next. There is no problem with this. Exclamation point, she says, if you're not reading along with us. Some people listen in the car or while they're walking or whatever. Nothing prevents you from taking an IRA distribution in December of 2023 and rolling it over in January of 2024, Sarah writes. As long as you be sure to follow all the rollover rules that apply. You will want to be especially careful of the 60-day rollover rule for rollovers during this busy time of year. You may wonder how to handle a distribution from your IRA in 2023 that you roll over in 2024 in your tax return. Let me go back to one for a second. This is important. We had a new client who contacted us. He had a small distribution from an IRA that was sent to him directly. And he's in a different part of the country. He was visiting here, and he was going to stop in and meet with us. And he said, I'll bring this check up. Well, that meeting didn't happen. And long story short, we ended up past that 60-day window for that rollover. So it was a very, very small distribution. Person's over 59 and a half. There were a couple really acceptable answers to this issue. One is, hey, just take the distribution. It's okay. It's not going to mean anything. So it was less than $200. But what if it had been $200,000? So that could have made a big difference. What if that person was under 59 and a half? That would have certainly have been a big difference. There's self-certification you could do for 60-day rollover violations, things like that. But the thing is that 60 days goes like that, folks. You put that check aside and you say, oh, I have to get to that. And suddenly, it's March and you say, oh my gosh, I forgot to do that. And if it's a big check, it can be a big deal. So, Number two, you may wonder how to handle distribution from your IRA in 2023 that you roll over in 2024 on your tax return. Do you report this transaction on your 2023 tax return or wait until 2024? Well, here's how it works. The IRA custodian will report the distribution from your IRA on a 2023 Form 1099-R. So 1099 shows there's a lot of different blocks on the 1099. It shows distributions. A 1099-R is obviously specific to retirement accounts. The rollover will be reported by the IRA custodian on a 2024 Form 5498. So the custodian for the distribution reports it on a 1099-R. And if that happened in 2023, they report it on a 2023 1099-R. The rollover, so the deposit into the IRA, which is called a rollover, will be reported by the new IRA custodian, or the receiving IRA custodian, I'll say, on a 2024 Form 5498. So the 5498 form offsets the 1099. Any difference there would be a taxable event. If you distribute $200,000 and you roll over $100,000, so if the 1099-R says $200,000 and the 5498 says $100,000, what do you have to do with the difference? You pay tax on the difference. The rollover will be reported by I read that. You will report the distribution and the rollover on your 2023 federal income tax return. Okay. Number 3, be careful not to fall for a common misunderstanding of the one rollover per year rule. Pay attention to this. I'm going to read it again because this is important. So not only do you have 60 days you have to pay attention to, these are rollovers, not direct rollovers, not a direct transfer, not something where the custodian is named on the check. This is when you get a check just in your name, and you have 60 days to make a decision about where you're going to put that money. That's still allowed. We're talking about 60-day rollovers here. Be careful not to fall for the common misunderstanding of the one rollover per year rule. So not only do you have to worry about the 60 days, but you have to worry about the 1 year, one rollover per year rule. The rule says that you may only roll over one distribution from all of your IRAs or any of your IRAs in 1 year period. In a 1 year period. The one rollover per year does not apply on a calendar year basis. It begins with the date you receive the distribution you later roll over. A new calendar year does not mean you have a clean slate. If you take an IRA distribution on December 15th, 2023 and roll over in January of 2024, you may not roll over another IRA distribution until December 16th, 2024. Again, not a direct transfer, direct rollover, not even a rollover from a retirement plan. We're talking about when you receive the check in your name, and then you're depositing it to your bank account or another IRA or what have you. But pay attention to that 1 year per rollover rule. It's been around for a little while now, but every time we do our slot updates, we spend the days, those days in class. We have case after case after case of these violated 60-day rollover rules. And in fact, a couple years ago now, they've allowed for self-certification, which means you can go in and select a series of, I think it's 8 different things that allow you to self-certify that this is what happened with my 60-day rollover. This is why. That's a good webinar topic. I'm just writing this down. Self-certification. This is why. So with the self-certification, you choose on the form. This is why I missed that rollover, and this is how I'm correcting it. Otherwise, you had to do what's called a private letter ruling, and the private letter ruling costs $10,000 typically, and then you write this letter to the IRS, and they come back to you with the results of the letter would say, I made this mistake. How can I fix it? Or this is what I want to do to fix it. And they would come back and they accept it or not. And that was, I think, the number one private letter ruling request that they received. So they did this self-certification. So if you're sitting there thinking, well, who does that? A lot of people have this issue with the 60-day rollover. So don't do it. It's easy to avoid, folks. Just get the check issued in the name of the custodian. Do all your work beforehand. If like we custody with Charles Schwab. So if you're rolling over IRAs to someone like us, Custodies with Charles Schwab get it made out to Charles Schwab and Company, custodian for your name. They can't do anything with that check other than deposit it into an account for your benefit. So don't worry about it. Don't worry about that. But much more concern about that check getting misplaced or mail being slow or whatever. So keep in mind that if you're establishing a new IRA with your rollover in 2024, your IRA custodian will not be reporting any 2024 RMD information to you. If you were rolling over an existing IRA, the RMD amount the IRA custodian reports to you will be less than your actual RMD. Good point, Sarah. This is because the IRA custodian reports RMD information to IRA owners based on the December 31st prior year balance with no adjustments. You must make the adjustment yourself and add in the amount rolled over to the December 31 balance to calculate your correct 2024 RMD amount. Good point, Sarah. All right, so 529 plans and qualified charitable distribution, today's slot report mailbag. So this is from our friend Andy. Here's your first question. I have been funding a 529 account for over 15 years and no longer need to add deposits. Good for you. Could I change the beneficiary to myself and then convert to a Roth IRA, assuming I have met the 5-year deposit hurdle as well? Has the government ruled on when the clock starts for the 15 years? Meaning, is it from when you open the account or does it restart again when you change beneficiaries? This is the $1 million question or the $15,000 question. The question is timely. Andy writes, as I wrote an article about this topic just yesterday for the Slot Report, there's a link there. $529 can be rolled to a Roth IRA for the 529 beneficiary, but only after the 529 account has been open for at least 15 years. Yes, you can change the beneficiary of the 529 to yourself, but we still don't know if that will result in a reset of the 15-year clock. As such, it might be best to delay any beneficiary changes until we have a definite guidance or we have definitive guidance from the IRS. And it appears to be, in my opinion, that the change of beneficiary will reset that 15-year clock. So next question, once the beneficiary of an inherited IRA has reached 70 and a half, is the beneficiary eligible to make qualified charitable distributions, QCDs, annually? We talked about this a few weeks ago. And the answer is yes, QCDs can be done from an inherited IRA once the inherited beneficiary is age 70 and a half or older. All of the normal QCD rules apply, like the fact a person must actually be 70 and a half to do the QCD. I'm making myself another note. It is not good enough to be turning 70 and a half later in the year. So let me pick up on that sentence because I broke it up with my note. All the normal QCD rules apply, like the fact a person must actually be 70 and a half to do the QCD. It's not good enough to be just turning 70 and a half later in the year. So some people think that, well, I can do a QCD this year. I turned 70 and a half. Let's say your birthday's in January. You turn 70 and a half in June or July. That always messes with me. But later in the year, and you say, okay, well, I want to do that now. I want to do my QCD now. And here I am in January, even though I won't be turning 70 and a half, really. I won't reach that half birthday until later in the year. I'm going to go ahead and do that QCD now in January. It won't count. You have to cross that 70 and a half birthday. These half birthdays are important. I jokingly say we should start celebrating half birthdays. So 59 and a half, 70 and a half, both very important birthdays. Also, it does not matter how old the original IRA owner was when they passed away. That has no bearing on QCD eligibility from the inherited IRA. Note that the QCD limit is indexed for inflation and has been adjusted to $105,000 for 2024. Good stuff as always, Andy. Thank you. All right, let's talk about the markets and then we'll move on. Last week was... I told you I was in conferences last week and I was checking in on the markets and I see, we had a nice little rally on Friday. So let's talk about last week. So sales rose. We had retail sales last week that came in. So, and these are reports that we get, retail sales report. The sales rose 0.6% month over month in December, better than expected. While excluding autos, sales were up 0.4% versus the 0.2% expected. Year over year, sales were up 5.6%, but that's not adjusted for inflation. And inflation was 3.4% in December, so you've got to back that out. Our analysts say the consumer remain in a spending mood during the holiday season. The coming months will be the key. Can spending continue as debt has grown and savings have been diminished? Industrial production, that was another report that came out last week. Production rose 0.1% month over month in December, but fell 3.1% at an annualized rate in the fourth quarter. Manufacturing, this is our analysts say, manufacturing continues to be relatively weak, but that has yet to filter through to the broader economy. Could be a sign that things might start slowing down. So also we saw the Beige Book. So the Beige Book is our notes provided to the Fed from member banks. And that showed a few regions reporting softening activity, but the others seeing stable activity or modest growth. According to the report, many districts reported solid holiday sales, reinforcing the retail sales report released earlier in the week. No big surprises here, our analysts say. The economy appears to be softening but remains resilient, helped by continuing consumer spending. This report, along with the retail sales report earlier in the week, reinforced recent Fed commentary indicating the central bank is in no hurry to begin cutting rates. I had a conversation with a fellow who's very analytical. Does a lot of market research while I was in Scottsdale, and he talked a lot about the Fed and his thoughts around cutting rates, and he's taken a very, very defensive position for 2024. So I thought that was interesting. The recent decline in mortgage rates should continue. I'm sorry, this was housing starts. So housing starts came in last week as well, and building permits starts. The housing starts fell 4.3% in December, as single-family home construction fell the most since July 2022. However, the forward-looking building permit report showed permits rose 1.9%. So the analysts say the recent decline in mortgage rates should continue to bolster housing construction, and their rising permits reading show a glimmer of that potential. It's interesting. The mortgage rates came down a bit over the past few weeks, but housing has still slowed. Even investor purchasing of single houses has dropped quite a bit. There is like large investors. All right, so what's coming up? So Friday, we see the Personal Consumption Expenditures Index, the PCE report. Investors will continue to key on the Fed favored price index as markets continue to price in more aggressive rate cuts than the central bank has predicted. People are really counting on these rate cuts, and I don't know if we're gonna see them in 2024. But it certainly won't be if we start seeing rate cuts. Won't be until the second half for sure. All right, they go on to talk about the surge that we saw on Friday. While the 10-year Treasury yield rose to the highest level since mid-December, we expect volatility to continue as market expectations for a Fed cut and Fed expectations come together. Earnings season will take the spotlight amid a modestly higher investor expectations. Leading to the possibility of misses getting more severely punished. All right. Oh, this is interesting. Congress pushed their budget deadline in March, and that's interesting. But again, this reinforces my feelings about this Tax Cuts and Jobs Act. The Tax Cuts and Jobs Act is set to expire in the end of 2025. 12/31/2025 is the end of the current tax code that we have in place right now, and we're going to talk about tax brackets in just a moment. But that's all set to automatically reset to 2017 levels. But I don't think that Congress is going to allow that to continue. That sunset to continue, because it's going to be seen as the as a tax increase on the middle class. But let's assume that happens. Let's assume that they kick the can down the road. I know that's a cliche, but that's really what they do. It is because we had a debt ceiling crisis, a couple of them, and these fiscal cliff scenarios that run till the 12th hour, and we had a budget that was due at the end of the month, and it was pushed till March. And I think this is the kind of pushing that they're going to do with these tax increases that we have to have. A good economist would look at our country's financial situation and say, a good planner would, if you put this in terms of a personal financial plan, you look at this and say, hey, changes have to be made. We have to do X, Y, and Z to get there. But that's not what the folks in Washington are doing. They're saying, okay, let's just continue this problem. Let's push it down the path a little bit, and we'll either deal with it tomorrow or we'll have somebody else deal with it. And that's where we're going to end up with our fiscal issue in our country. All right, so off that soapbox once again. Let's look at what happened in the markets last week. So the Dow Jones Industrial Average was up 0.76% for the week. It's up 0.55% for the year. The S&P 500 was up 1.19%, and the NASDAQ was up a whopping 2.26%. Already 2% positive for the year. The year-over-year number for the NASDAQ is 42.33%. So that's this time last year to this time this year, right? This is the close of business in January. So really good start. Bonds are not doing well so far this year. So the aggregate bond index was down last week 1.10%. It's down 1.139% so far this year. So that's the general markets as a whole. International, well, I'll give you some more. The international markets were down pretty much across the board last week. So pretty significantly. So outside of the U.S., things aren't performing as well. Down 2 to 3% kind of across the board. Interest rates were up slightly, as we talked about. So the 6-month Treasury went from 5.17 to 5.22. And the 2-year Treasury, so that's a federally issued, when I say 6-month Treasury, 2-year Treasury, 10-year Treasury, they're federally issued bonds or notes that mature at these certain times. So they mature in 6 years, they mature in 2 years, they mature in 10 years. So the 2-year U.S. Treasury went from 4.14 to 4.38, and then the 10-year U.S. Treasury went from 3.94 to 4.12. All right, coming off the markets, let's talk about our Financial 15. This will start our Financial 15 segment. So I'm going to share my screen here with you in a moment, but we're talking about the tax bracket increases. So this Financial 15 segment, if you're just joining us, please hit the subscribe, like, and notification button. But today we're going to talk about some of the changes in the tax brackets. So these are just the tax bracket. There are other changes that come about in 2024 that we'll talk about over the next few weeks. That's retirement plan contribution limits, changes in the IRMA brackets, income-related monthly adjustment amounts. But today we're just talking about tax bracket updates. We're going to talk about why these are important. So I have both tables here, 2023 and 2024. Currently, you can download these tables, 2023, on our website, attleborowealth.com. If you just go to attleborowealth.com, let me just pop that up here if you're just joining us. So that's, I got it the first time, attleborowealth.com. And you can go to the Slott corner, SLOTT corner, and scroll down. And Doug, I see your question. Let me take that question offline. We'll talk about that later. So Doug asked, shouldn't bonds go up if interest rates decline? It just depends on the longevity of the bond, the maturity of the bond, the duration of the bond, the type of bond. There's a lot of it depends in there. So what was I saying? Oh, go to the Slott corner, and you scroll down in there, and you'll see some information about the Ed Slott Group. And at the bottom of the page, you will see these charts that you can download. So let's go back to this here. Okay, so currently we have the 2023 charts up, and by the end of the week, we'll probably have 2024 up. But we want to pay attention to a couple different things, and I'm gonna highlight these a little differently. But let me just give you the breakdown of how to look at this chart. So these over here on the left here on the top section on both of these, again, 2024 to 2023, these are the marginal tax rates. So these are the rates for your ordinary income tax. So whether you earn your money, through your job, whether you have short-term capital gains, whether you have ordinary dividends, everything that's going to distributions from your IRAs, your traditional IRAs, your traditional retirement plan, anything that's going to flow into the ordinary tax funnel, right? Or we refer to it as a graduated cylinder often in our classes, will end up in these marginal tax rates, and that's just where people get the brackets, right? So let's look at the different brackets. So we start at 10%, and currently we go all the way up to 37%, and we have these different income levels within these brackets. And as soon as you cross over one of these levels, you start entering into the next bracket. So for 2023, the top of the 12% bracket, for example, was $89,450. And for any dollar earned over $89,450, any taxable money earned over that amount would go into the next bracket. Let's just say it was only $1. Well, only $1 of that, if it was actually $89,451, and that $1 crossed over into that 22% bracket, well, only $1 would be taxed at 22%. From $22,000 to $89,450, that would be taxed at 12%. And from $0 to $22,000, that would be taxed at 10%. So it does actually kind of flow in like that's David McKnight's analogy, is that graduated cylinder. If you've got, we use that in science class, we've got this cylinder, and you think about these as your marginal tax rates, right? We get 10, 12, 22, 24, 32, 35. Got to add one, 35, and then 37. So as things fill up here, you pay those $0 to $22,000. These are 2023 numbers I'm showing here, as you pay at the 10% bracket. And then anything as it crosses over here, you pay at 12%. And anything as it crosses over the 12% threshold, remember $89,450, you pay 22%. So that's where you get your blended rate, or your effective tax rate. All right, so now that we know how this works, let's look at how to read this chart. Again, I'm using 2023 as an example, but we're going to move into 2024. Trust tax rates. So here you have your individual tax rates. So whether you're married filing jointly here in this middle box, or you're single, this is how your funds are taxed. So again, these are your levels of taxable income and your tax rates. So if you're single, you'll see that you top out at the top of the 24% bracket much, much faster than somebody who's married. It's really cut in half. So your tax rate goes up much faster when you're single, because the amount of money that it takes to trigger that tax rate is much lower. I hope that makes sense. In this case, you can see $364,200 compared to $182,100. So they're your individual tax rates. Then you have trust tax rates. So I get a lot of questions when we're doing financial planning about, hey, should I have my funds in trust? It depends on if it's an irrevocable trust or a revocable trust. But trust tax rates are not very favorable, because I want you to look at this. Any income that's over $14,450 in a trust is taxed at 37%. Whereas an individual, whether they're married or single, you're either at $693,000 for 2023 or $578,000 for 2023 before you hit that 37% bracket. So trusts, although they have similar marginal tax brackets, not exactly the same, but similar, they're taxed much, much higher, and it's the same with capital gains. We're not going to spend any time on qualified business income deduction. We're going to talk more about these two other items here, standard deductions and capital gains. So these are the long-term capital gains rates or qualified dividend rates. And this is really important. You can either be taxed at 0%, 15%, or 20%. You can pay 0% on your dividends or capital gains, qualified dividends or long-term capital gains. You have to be within these income brackets. And as you go up, just like your marginal rates, it goes from 0 to 15%, and then anything over $553,850 for 2023, or $492,300 for a single filer, then you pay 20%. And then you see these little asterisks, and that is a Medicare surcharge tax. So it goes from 15 or 20% to 18.8% or 23.8%. That's because there's a 3.8% Medicare surcharge. So that's how to look at that chart. Now we're going to compare the numbers side by side. So I'm not going to have us cross over like this. What I did was I clipped these for us, and I took these right out of the, I just clipped them out of the big chart, and I put them side by side. So now we're looking at the taxable income brackets for 2023 compared to 2024. So obviously 2023 is on the left here and 2024 is on the right. So let's see how they increased. So I just told you that a married filing joint couple from $0 to $22,000, they pay 10% tax. Well, now that's $23,200, that top of that. So obviously an increase of $1,200. And these all come in at about, let's just call it 5.4% increase. Single filers, it's the same. It's a $600 increase here. But you can see, so these are the rates that we're working with now because we're crossing over into 2024. Now, of course, you got to calculate these 2023 rates on your tax return if you're still, for some reason, doing it by hand. But most of the tax planning, and that's why this chart is called tax planning, not tax preparation. But most of these tax charts are used for planning, not calculation, because most people use some kind of program or they have a professional who does it for them, and certainly they have a program. So you can see the 12% bracket for married filing jointly goes up, $4,850 to $94,300. For single filers, it goes from $44,725 to $47,150. Not surprisingly, one half of that increase, $2,425, compared to the married filing jointly. And for the top of the 22%, you're at $190 for 2023, and now at $201,050 for an increase of $10,300. For the top of the 22% bracket for a married filing joint couple. And for a single filer, you go from $95,375 to $100,525. That's $5,150 increase for a single filer. And then the top of the 24% bracket for married filing jointly goes from $364,200 to $383,900 for an increase of $9,850. And for single filers, it's $182,100 goes to $191,950, an increase of $19,700 for married filing joint, and $9,850 for single filers. So that's important. Why is that important? Well, the more you can have more income with less tax, and these brackets here, 22 and 24, certainly here too, but a lot of times, let's just call it any of them. These marginal tax rates are our Roth conversion corridors. So these are the numbers that we use to make the decision about how much we're going to convert from traditional IRA to Roth IRA. So what that means is that we can do, if all things being equal, and we want to take somebody to the top of the 24% bracket, that gives us another $19,700. That's a big deal. So let's just call it $20,000 more that we can convert. And if you've got, $100,000, that saves you 5 years. How can I say that differently? We can move things faster. Let's put it that way. So at $20,000 a year, we can move an additional $100,000 over a 5-year period. I think that makes more sense. I think I said that better that way. So these escalations help us tremendously when we're when we're converting from traditional IRA to a Roth IRA, because if we had included this $19,700 that we now are able to convert up to the top of the 24% bracket in 2024, if we did that in 2023, this $19,700 would be taxed at the 32% bracket. But now it can be included in the 24% bracket because the brackets have expanded. I hope that makes sense. So there are the differences in the ordinary income tax rates. So now let's look at capital gains. So remember what capital gains are. So capital gains are gains that come from growth within your investments. So outside of IRAs, traditional IRAs or Roth IRAs, in your taxable account, that account, remember your buckets here, right? We've got taxable, tax deferred, tax advantaged, or tax free. So these are your IRAs, 401ks, etc. Traditional. Anything tax advantage or tax free, that's anything Roth, and some properly structured cash value life insurance. Kind of here in your taxable bucket is everything else, your CDs, mutual funds, stocks, bonds. So capital gains, of course, is you buy something at $1,000, it grows to $5,000, or it grows to it could grow to $5,000, but let's make it simple. Grows to $1,500. That growth from $1,500 could be taxed at short-term gains if it's below 1 year, or it could be taxed at capital gains, long-term capital gains, which would fall under this type of tax if it's greater than 1 year. And then you have dividends. They're either qualified dividends or ordinary dividends. Ordinary dividends and short-term gains get taxed at these rates up here that we talked about. But if they're qualified dividends or long-term capital gains, they're taxed at these rates down here. And these rates are favorable. They're these capital gain rates. So a really good example is we had a client who bought a stock who had appreciated quite a bit, and he wanted to put a sell order on it if it fell below a certain level. And one of the parameters was, well, let's make sure that we're beyond 12 months so that if I get sold out of this position, that it doesn't add to my taxable income up here. It gets taxed at these preferable rates down here. So these are long-term capital gains, and that's typically greater than 1 year, or qualified dividends. Okay, so you'll see here that these increases are similar. It's about, let's see. I don't have the number here, but it's about the same. It's about 5.48% or 5.4% increase. So to pay zero tax, you were looking at an income of $89,250 compared to the increase, that's for 2023, of $94,050. So that is $4,800 for a married couple and $2,400 for a single couple. Goes from $44,625 to $47,025. Your 15% goes to from $89,251 to $553,850 to $583,750 for a married filing joint couple, and from $492,300 to $518,900 for a single filer. It's a big jump for a single filer. It's also, a big spread for a single filer. We don't see it. The single filers really get hurt with ordinary income, not so much with capital gains. It's a difference, of course, but it's not as great. And then anything over these numbers is taxed at 20%. So that married filing joint amount over 20% over $553,850 jumps to anything over $583,750 for the 20% capital gains or qualified dividend rate. Single filers goes from $492,300 to $518,900. Anything over that, and then that's it, right? That's it. There's only 3 brackets. Don't forget this 3.8% Medicare surcharge, and that is for based on modified adjusted gross income. So that can make this 15%, 18.8%, and this 20%, 3.8%. So these brackets have increased. So that's good. Again, you can have more capital gains, you can have more qualified dividends, and you're going to be taxed at a lesser amount, potentially. But I want to point something out to you before we end for today, because they're the updates for the 2024 tax brackets, capital gains. Oh, did I include? Oh, the standard deduction also went up. Let me grab that before we talk about this next thing. So the standard deduction went from $27,700 to $29,200 right here. So obviously, that's an increase of $1,500 for married couple, $750 for single filers, and if you're over 65. That went up $50 a piece. So from $1,500 here, are you seeing that? Yeah, to $1,550 for in 2024, and for single filers that went up a full $100. So from $1,850 to $1,950. So that's good. So that's also your standard deduction. So if you don't have deductions over that amount, everybody at least gets $29,200. If you're married, $14,600 if you're single. And if you're over 65, you get a bit more. And then you see head of household there as well. But back to capital gains, let's talk about this for a second, because this part is really important. Remember, you've got this extra surcharge, this 3.8% surcharge. If you earn over a certain amount, we're going to talk about what that certain amount is in a second. Your capital gains brackets went up, not your percentages, but the amount of income that can fit in those percentage brackets. So that's a good thing. It means you can earn more and potentially pay tax less tax on those earnings. But the thing that triggers that 3.8% surcharge hasn't budged. Let's look at this. So what is that 3.8% surtax, that surcharge based on? Well, it's based on, for 2023, it's based on a modified adjusted gross income. That's what MAGI means, modified adjusted gross income. For a married filing joint couple, that's $250,000. For individuals, that's $200,000. For married filing separate, $125,000. And for trusts and estates, it's $14,450. So I want you to remember that for a second, because I want to slide over here. The only thing that changed in this is the trust and estates. This one's the same, this one's the same, and this one's the same. What does that mean for you? That actually means that more people are going to be subjected to the 3.8 surcharge, 3.8% surcharge, because the triggering incomes haven't gone up one iota other than for trusts. And I don't know how many people the trust part affects, but it's much, much less than the individuals. These are, and that because it's the only one that's indexed for inflation. The other ones are not indexed for inflation, which means they're not going to change. They are unlikely to change. These are those phantom tax. This is an example of the phantom tax that these phantom tax increases that are going to happen year over year over year, and Congress doesn't have to do anything for that. More and more people are going to be affected by this. So while the marginal tax brackets, the amounts, the income triggers inside the marginal tax brackets will go up every year, these certain things like this, the 3.8% surcharge, the surtax on net investment income or on qualified dividends, things like that, long-term capital gains, that will stay the same, so more and more people will trigger. I hope that makes sense. The other one that really gets me, so many people are going to be more affected. Their capital gains taxes are going to be greater because of this issue. But the other one is, I think I grabbed that here, provisional income. Yep, it's right down here. So this is the tax, the provisional income, if you might remember, and we'll talk about this in our class. That's the income that the IRS that tracks to determine how much of your Social Security is subject to tax. So you can see the numbers here. So modified adjustment gross income, same thing that's tracked on the Medicare surcharge, right, that I just talked about, modified adjusted gross income, up to 50% taxable. So anything below these thresholds is zero tax on your Social Security. But once you cross over $32,000 if you're married, to $44,000, up to 50% of your Social Security is subject to tax. If you're single, once you cross over $25,000 in modified adjusted gross income, up to $34,000, up to 50% of your Social Security is subject to tax. Then it gets worse. Up to 85% of your Social Security is subject to tax once you cross over $44,000 of modified adjusted gross income for a married couple, and $34,000 of modified adjusted gross income for a single filer. And this table is not adjusted for inflation, just like the Medicare surcharge net investment and investment income chart that I showed you, not adjusted for inflation, which means it's been the same for years. It's not going to increase. And more people are going to be subject to higher tax rates in their capital gains and higher tax rates, more tax on their Social Security. So watch out for that. While it's good news up here, folks, that these Roth corridors, Roth conversion corridors we talked about, that we can move more money over to Roth IRAs via conversion, because now we top out for a married couple at $383,900 compared to $364,200. That's all good news. For capital gains, again, good news. You can stay in the 15% bracket for capital gains tax, long-term capital gains and qualified dividends up to $583,750 for a married couple compared to $553,850 in 2023. That's good, but the Medicare surcharge is going to hit more people sooner because their incomes are going to go up above the $250,000 modified adjusted gross income. And you're going to start seeing that 3.8%. So, and then, of course, Social Security, more and more people are subject to tax on their Social Security because those provisional income rates have not changed since I've been focusing on tax-efficient planning. Doug asked another question. What is qualified dividend and how to find them? So qualified dividends are, it's not like a waiting period or anything like that, Doug. It's a dividend that comes from a position, whether it's a mutual fund, a business development company, closed-end fund, or an individual stock, it's how it's set up. So the dividend is going to be qualified or it's not going to be qualified, and that'll be either on the investor relations information, if you call investor relations for the company or you look at their website, your custodian should be able to tell you, and certainly your advisor should be able to tell you. So if you have any questions, contact me directly at questions@attleborowealth.com, or that's questions@attleborowealth.com, or Doug, you can email me directly. Okay, folks, that was a lot of information. It's 11:02. It's good to see you all back. We'll be back next week, and we're going to continue down this road of updates for 2024. If you're a client, you need to reach out to us. You have our contact information. If you are not a client and you want to schedule time with me, you can reach out to us at questions@attleborowealth.com, and you can ask we'll help you find a time that works for us. Thanks, everybody. Have a great week. We'll see you soon. Take care.